This part covers one of the most important aspects of successful trading tactics, which is worth considering several times until it becomes second nature to you. Emotions are crucial elements in our everyday life, but they are not our friends when trading. Hope, for example, is an emotion that helps us make it through the day. Hope, however, is a forbidden word in the trading business. There is no such thing as a hope here. You use your trading tactics to select trades and probability law will do the rest. If you enter a position and find yourself hoping, something must be wrong and you better close that position. Let's suppose that you flip a coin and have two choices. Choice A, if it's heads, you gain 1000 US dollars. If tails, you gain nothing. Choice B, you gain 400 US dollars whether it's heads or tails. While the majority of people will pick B because it seems a less risky option, picking A means that you could gain much more. Probability is an important part of trading. You should always calculate probability instead of hoping to gain something. If risk-reward sounds good, then you just enter into a trade and wait for probability law to materialize itself. As the old adage says, cut your losses early and let your profits run. This is the basis of most successful tactics. But people often do the opposite, by locking in a small but sure gain early on, while allowing their losses to soar, hoping that loss will somehow turn into profit. People naturally avoid risk, because enduring a loss is more painful than a gain is pleasurable. And that happens because they let emotions interfere with their trading decision-making processes. Once you set your stop and profit levels in advance, do not change them. It is best to determine those levels in advance before you enter into a trade, because during the planning phase of your trade you are calm and rational. It is hard to stay calm and change decisions when you are already in position, because the emotions of fear and greed will try to influence your decision. Are you able to stay calm and adapt a poker face? Ask someone if they can decipher your present emotions. Let them try and guess whether you are losing or gaining during a particular trade. If they cannot guess it, you are good. Give yourself a poker face and feel that way. It is strongly advised not to involve any emotions during trading, because they are counterproductive. When trading, get rid of hope, worry, fear and greed. This is worth repeating. Exclude those emotions from your trading activity. Don't let your ego influence your trading decisions. A strong ego has caused some of the most spectacular losses in the history of trading. If you find yourself calculating how much you will earn, distract yourself and stop thinking about it immediately. If you realize that your emotions are trying to interfere with your trading activities, stop trading and wait until you feel calm and lean again. This may take 10 minutes, an hour, a day, or a week. If you feel emotional pain or any pressure during trading, you are probably too leveraged, risking more than 3% of your deposit or risking money you cannot afford to lose. Remember, there is no such thing as easy and fast money. You have to apply discipline and patience, stick to the plan, and the results will come. Finally, don't overtrade. Don't trade for the thrill of trading. This is a wrong motivation for this business. Your goal is to preserve capital and try to earn more than you lose by picking only trades with a good probability and risk-reward ratio. If the market is undecided or choppy, don't feel the urge to trade. Sitting out less lucrative market conditions can be as worthwhile as trading. Save your money for times in which the situation is clear and simple, and never ever commit revenge trading, seeking to reverse a pattern of losing trades. This will devastate your account and your emotions, and it will kick you back to square one. Once in a position, do not calculate your gain or loss minute by minute. Rather, allow a trade time to develop. You have decided to enter a trade based on your tactics and a good risk-reward potential. That's all you should do, and that's all you can do. Time and probability law will do the rest. Once in a position, force yourself to be distracted and watch a position as if it has been opened by someone else. Force yourself not to feel good if a trade is going in your desired direction, and vice versa. After a month, you can evaluate whether your overall tactics have been productive, but not before. Never look at the trade in terms of real money. Always use the pips value instead. This is about the score, not financial gain or loss. Remember, money is an aside to successful trading tactics, not the main goal. In trading, as in banking, money is given to those who don't desperately need it. The trader is like a well-equipped army general who only selects battles where the odds are on his side. Why fight hard battles when the odds are slim? Spare your equipment and men to fight the easiest battles. Do not close your trade too early, rather let the situation develop, and never broaden your predetermined stop. During the preparation phase, you may plan to move a stop if the trade moves in your direction, usually close to next support or resistance level. Do not change your mind. Only move a stop if the desired situation materializes, so that you are able to lock in some profit and lower the risk on that trade. But only do so if this was part of your original tactics. Never change your mind when already in a position.